Now we're ready to begin talking about our first set of what we're going to call macroeconomic models. Now, a model sounds like a sophisticated term, but really all we're trying to do is take all the very complicated pieces of the macroeconomy and break them down into smaller parts so we can understand. Well, if we want to understand the big, sometimes we have to start at portions of it to get an understanding of the big. Let me go back and review. How do we define our economy? It's defined as adding up all the expenditures, or we could add up all the incomes. And in a couple of chapters ago, you learned a bit about how to do that. From this point on, we're just going to focus on the expenditures effect. I'm going to put up a prop here. So if you remember, GDP is made up of consumption spending, which is spending by households, investment spending, which is spending by businesses, G, which represents government spending of all levels, federal, state, local, county, city governments, and then X represents net exports, meaning the spending by foreigners to buy U.S. goods. So GDP is made up of these four pieces. If you look on the inside cover of your book, what you'll discover is, of these four pieces, these two pieces alone make up close to over 80% of all GDP. So if we understand what drives consumption spending and investment spending, we're gone a long way to understanding what drives GDP. So that's what we get started on in chapter 27. What drives GDP? Well, the two big pieces are C, which is consumption spending, and I, which is private investment spending by businesses. All right, to get started on that, well, what drives consumption spending? In other words, how much money do people spend? Why do they spend it? Well, one of the biggest reasons people spend money is they have income. Obviously, if you have no income, you can't spend it. So one of the big drivers of consumption spending is how rich they are, how much money they have coming in every month. That's what income is, your cash flow, if you will. It's a little bit different than wealth. I want to distinguish between income, which is your monthly or your weekly earnings. That's the money that's coming in regularly, versus wealth, which is how much money you've amassed over time. Think of wealth as like your savings account, or if you have a car, or if you have a house. Those are wealth. You don't spend those things. Those are assets that you own. That's your wealth. Income is the money you spend every month because that's your paycheck. If you look on page 548 in your textbook, what you see is a relationship between income and spending. Basically, the more income we have, the more money we spend. Notice also there's two lines there. The red line represents, it's like a benchmark. The red line just says, well, what have we spent every penny we earned? That would be the red line. So if we earn $6,000 and we spend $6,000, that would be a graph like the red line. But notice there's a little bit of a gap between the red line and the consumption line. That means we save some of our money. We don't spend it all every month. Notice the gap gets bigger the more the income. In other words, the more money we earn, then we can save a bigger part of it. Makes sense. All right, so notice if you turn the page on 550, what you'll see is that same relationship, kind of in an informal way. Notice that consumption line, which is the green graph, crossing that 45-degree reference point. At some point, that consumption line is actually above the 45-degree line. To the left, that means at low levels of income, you're actually spending more money than you're taking in. If you're a college student like I was, that was my case then. I was spending more money than I was earning, and therefore my consumption was higher than my income. But as I graduated from college, actually got out and made some money. Now I was starting to save money. I would move to the right, and now I was spending less money than I was earning, and I was saving some money. That's the consumption schedule. That's what that represents. The part of that graph on the bottom part on page 550 of the graph shows the saving schedule, which is kind of literally the same thing as just looking at it from the savings perspective. Again, to the left at some point you have negative savings, mean you're drawing out of your savings account or you're getting loans or whatever. To the right of that graph, saving is positive, so you're actually saving money. But another thing we need to understand about consumption, it's driven by more than just income. Income is clearly a big driver, but how much we spend is also affected by wealth, how much wealth we have, how big is our stock portfolio, how many houses we own, and so on. That would also help us spend more money. Another thing about our spending is affected by our attitudes. What if we just feel like spending more money? Hey, yippee, let's go spend some money. Let's go buy a new boat. Let's go buy a new car. Let's go buy those new clothes. For whatever reason, absent even income levels, we say, let's go spend more money. So that could drive a shift in that consumption schedule. In other words, that line where it is on the graph could shift and move because for whatever reason, we just simply want to spend more money at every level of income. That could also be affected by interest rates. When interest rates are low, we can borrow more money, therefore we might spend more money. So consumption, if you really think about it, is driven by income levels, by our attitudes and expectations, by how much wealth we have, and by interest rates. Let's keep that in mind as you read this. A second big part of our CIG&X of GDP is investment. What drives business spending? Well, the biggest driver of that is interest rates. How much does it cost businesses to borrow money so they can go out and grow their business? Let's just take a very simple example. Say you're running a flower shop and you're doing real well in your business. You're making flowers, bouquets, doing funerals, Mother's Day, all kinds of customers for your floral business. Well, one of the things you need to do is be able to deliver your flowers around town. So you say, maybe I want to get a delivery truck so I can deliver flowers and make my business get even bigger. Maybe you don't have the cash on hand to go out and buy the delivery truck. So you're going to have, like most people, you go out and borrow the money for the delivery van. Let's just take a very simple example. Let's say the delivery van is going to cost you $10,000. And let's say your assessment is that actually generates $1,000 extra of income for your flower business. So the extra $1,000 divided by the $10,000 investment means you're earning about 10% on that truck. Costs you $10,000, but it's bringing in $1,000 every year, so you're earning 10%, 1,000 divided by 10,000. So if you could go out and borrow money at something less than 10%, then that would be a good deal for your business. Say you can borrow the money at 6%, pay for the van, and you're making 4% on top. That's cool, and that's what businesses do. So your investment decision is going to be driven in big part by how much you have to pay in interest rates. So that's what's shown on the graph on page 556, is this relationship between interest rates and how much businesses invest. Notice it's a negative slope line, meaning the lower the interest rate, the more businesses will invest. Take our delivery case, 6%, we're going to borrow it. What if I had to pay 12%? I'm not going to borrow it because I'm only earning 10% on the truck. So at 12% interest rate, forget it, I'm not going to do it. So the interest rate on the graph on page 556 is the amount of interest that the business has to pay. It's not the earnings that they're going to earn off the investment. One other thing that might affect that line that's on page 556 is think about it's not just the interest rates. That's a big factor. But let's go back to our simple flower shop. We assessed that the delivery truck could earn us $1,000 a month. We don't know for sure that's going to happen. That's just our assessment based on kind of historically, that's what's going on with our flower business. But what if our attitude changes about the flower business? What if for whatever reason the town that we're in is growing rapidly and we say, you know, I bet I can make more than $1,000 a year with that truck. I bet I can make $2,000. Therefore, I think it's really 20%, not 10%. So that would shift that investment line to the right, meaning at every interest rate I have to pay, I'm willing to invest more money because I have greater prospects. So business attitudes or expectations are going to drive that investment. Another thing that's going to drive that is profits of the business. If I'm making more money, I'm going to invest more in my business. If I'm making less money, then I'm going to invest less in my business because I'm going to take fewer risks. Finally, taxes would affect it. Operating costs of my business and technology are all going to drive that investment curve. Those things could all cause investment to shift to the left or the right at every level of interest rate. So C is based on income, but also expectations and wealth and interest rates. Investment spending by businesses is affected by interest rates, but also by profits, operating costs, taxes, and technology. All these things affect C and I, which is our two biggest pieces of GDP. Finally, a last piece in this chapter, in chapter 27, is we're talking about something called a multiplier, which means every new dollar I get, I'm going to spend some of it and I'm going to save some of that. And when I spend some of it, that represents income to a new business. He's got new income, so he's going to spend part of it, save part of it, and so on. So that first new dollar earned can actually generate a multiplied effect of income throughout the economy. If you read the short article on page 563, it's a humorous attempt to kind of explain the multiplier effect. As always, if you have questions, please let me know. But here's a brief introduction to our macroeconomic model.